more. And then it was like I hit my first day that I broke $1,000, and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You got to make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. 接下来我们真的要上火箭。The king would be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce. And he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to, show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。接下来大家会越来越依赖这种购物方式，
会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
the waves are generated far from the coastline. So the wind blows on the surface of the water, causing the water particles to rotate. And that rotation extends deep down below the surface. And the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built, the higher the waves, the higher the pressure, which is used to turn the hydromotor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100 kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Ina and her team are working on another 100 kilowatt project at the Port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you're up from this side. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in this for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn, and he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passy. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passy was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
Yeah, it's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Hari Nada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Hari Nada was somebody who actually recruited me into the company. So I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Hari Nada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Hari Nada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Hari, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered, for me, the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama Court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rob Posse didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth in around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going. And I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She says she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place, the granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. You know, Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it.
WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, you know, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his, you know, oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made, you know, very large amounts of money as a young man. But, you know, inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil is going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it. Might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. You know, one obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That, you know, they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that, you know, we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, What we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop
a series of tubes that would transport people in pods at ultra-high speeds over long distances.
This is a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. Bended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
And the number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving. And most importantly, they've probably gotten off of one before. They've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest, because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements.
Right.
We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market has snapped a two-day slide, and the major market measures right now are near session highs. 2 p.m. on Wall Street. I'm Doug Krisner at Bloomberg World Headquarters in New York. There are a couple of things to consider as a part of today's trading. First, a warning from Microsoft on the negative impact of a stronger dollar. We also heard from the vice chair of the Fed, Lael Brainerd. She was saying it's hard to see the case for a pause in Fed tightening in September. The oil story has become a significant one as well. OPEC Plus agreeing to increase the size of its oil supply hikes in July and August by about 50%. But oil prices right now are trading higher. You would think the OPEC news would have the opposite effect. Well, not the case today, because the market is really focused on news of a drop in U.S. crude inventories. WTI right now better by about 1.3%. We're trading 116.80. Dow Industrial Average right now is up about 0.7%, and we have the S&P higher by 1.2%. NASDAQ comp rallying today, something greater than 2.2%. Now, in terms of economic news, the day was kind of mixed. Durable goods orders increasing in the month of April more than expected. However, the employment figures from ADP show U.S. companies added the fewest number of jobs since the pandemic recovery began. Bear in mind, tomorrow, it's that May jobs data. Special coverage for you here at 8:30 a.m. Wall Street time on Bloomberg Radio. The Treasury market right now pretty calm, with the 10-year yielding 2.91%, very little movement there, and at the shorter end of the yield curve, a 2-year at 263. But the dollar, quite a bit weaker, with the Bloomberg Dollar Spot Index down about 0.7%. That weakness seems to be correlated with a move into currencies like the euro and the yuan. In China, for example, the city of Shanghai is nearly fully reopened after a 2-month lockdown, and in Beijing, restrictions are being lifted. So the offshore Chinese currency right now up 0.6% at 6.66 against the greenback. That's your Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Welcome, everybody. It is Friday's Eve, otherwise known as Thursday, June 2nd, 2022. Carol Masser, along with Bloomberg Quick Takes Tim Stenovic. We are live in our Interactive Broker studio. We are streaming on YouTube. All it takes is a mixed batch of economic
That's
news.
it.
And then
That's
look
all
what
it
we
takes.
get. We get a rally.
Yeah, look at that. Yeah, as you just heard from Doug Krisner, stocks higher across the board. The NASDAQ, though, leading the pack higher by 2.3%. We're going to talk more about that in just a minute. Also, that mixed bag of economic data and what exactly it means. Also, a lot of Fed speakers today, Carol.
Yeah, I mean, they're out in full force trying to get it in before that next Fed meeting. That's what it's all about. So we're going to break that down in just a moment. Also, we're going to break down what happened with Microsoft. Although stock was down 4%, it is flat now. But
That's why I didn't pick it for one of my decliners. I just saw the direction it was going.
It could be a gainer almost, maybe. They're out with a warning. We're going to go over it. Or Anurag Rana's like, I don't know what the big worry was about, and he was right.
He was absolutely right. Hey, we're also going to continue, speaking of tech, to go over the news of Sheryl Sandberg leaving Facebook, also known as Meta Platforms. The story we're focusing on today, how she leaves behind a complicated legacy.
It's always complicated, isn't it? Hey, speaking of complications, talk about the energy markets as OPEC opens up the spigot and the EU gets tougher on Russia.
And we round out the program with the CEO to talk about all that's going on when it comes to the global economy, the trend toward intelligent buildings, renewables too. Chairman and CEO of Johnson Controls, George Oliver, will join us. Looking forward to that.
Yeah, me too. And also Tommy Hilfiger coming home with a business program at a local college. So we're going to hear exactly from the designer. First up, though, let's get to the Market Drivers Report. Let's set your Business Week agenda on this Friday's Eve. Michael McKee, International Economics and Policy Correspondent at Bloomberg via Zoom. Hey, Mike. Did we do something?
morning.
You didn't
Good
want to be in
afternoon.
studio with us? What happened?
Yeah, I just figured you guys had cooties or something, and I'd stay home.
You're right. He's right.
Prepping for jobs, things like that.
I know, you're a busy man. Also busy is Gina Martin Adams, just keeping track of the rotations, the moves when it comes to the equity trade. She is Chief Equity Strategist at Bloomberg Intelligence. On the phone from New Jersey. Gina, let's start with you. Rally underway. What's going on?
Yeah, I mean, I think that the market, first of all, a couple of weeks ago, we did reach some version of an extreme with valuations reaching levels that last recorded in 2002, kind of markets getting to a point of having erased most of the bubbly conditions, and investors are picking away at stock, have been picking away at stocks ever since. You know, I have to say a lot of it, though, does seem to be sentiment around the Fed, where investors are saying, okay, maybe growth is going to slow enough that the Fed can slow their pace of gains at the very least into the second half. At the same time, China starting to reopen certainly reinvigorates the global outlook to a certain degree. And then you pile on with that the possibility of maybe a little bit of supply coming online in the oil complex to relieve some of the pricing pressure there. And we have a bit of a rally on our hands for the last few weeks.
Let's bring in Michael McKee, international economics and policy correspondent at Bloomberg News. Mike, I want to start with economic data and then get to the Fed a little bit later, because I don't know about you, but the ADP numbers coming in really pretty light. Estimated 300,000 versus gains of 128,000. Should we be reading into this that things are cooling?
I think that's fair. That things are cooling. The Bloomberg consensus for tomorrow's payrolls report also would show a cooling. Now, the ADP numbers have come in below the payroll numbers on a regular basis, so it could be that ADP is about where it wants to be, and payrolls will come in about where the consensus is. But in any case, we're expecting cooling. 325,000 would still be a lot tomorrow if we were talking about pre-pandemic. But it's coming down because basically because I think people who are going to go back to work have gone back to work. So companies may have some fewer job openings and maybe doing a little bit less hire.
Interesting. I do wonder if it feels like we're increasingly, Mike, and I want to get back to Gina in terms of what it means for earnings, but Mike, it does feel like we're increasingly starting to see, slowly but slowly, economic data points that show that what the Fed is doing is having an impact.
Well, we certainly are with things like new home sales, which we made a big deal of last week. And then yesterday, a lot of people weren't focused on this, but auto sales came in light. And those are the two most interest-sensitive sectors of the economy. So, yes, with higher rates, we are seeing some impact. And the question is, do we then see some additional impact in discretionary purchases? We'll have to wait later in the month to see that. But if that's the case and the economy starts to slow down, we could see things move more quickly in terms of inflation than anticipated. Remember, inflation's going to come down because a good part of it is pandemic related. It's just a question of how far and how fast and whether that means the Fed has to keep going.
You know, what fascinates me too, Gina, is I love when we see like Ford investing billions in the Midwest in terms of plants. I mean, companies are doing deals, they're doing things. We have to remember that there's still growth in this economy and companies are spending money and doing stuff, if you will. So, how do you see it? I know you watch the earnings projections, what's going on with revenues. You talk a lot about margin compression. What kind of corporate environment are we setting up for?
Yeah, it's really interesting, and I'm glad you bring it up, Carol, because I think that the sentiment has gotten so bad in sort of trying to predict whether we're headed for an economic recession, how much we're going to slow and the like, that we forget that earnings are still growing. And the only thing that's really changed is the pace of earnings growth is slowing and expectations going forward are moderating, but they're moderating from very high levels of earnings growth expected to moderate levels of earnings growth expected. And even on the margin lines, it's the same story. It's not that margins are actually falling. As a matter of fact, they're still rising for the most part and in most sectors in the S&P 500. It's just that analysts are reducing their expectations. So a lot of what's happening in the fundamentals at the company level is just a moderation in expectations from levels that existed 3 months ago. Certainly no indication of an earnings recession on the horizon. You'd have to get a much greater slowdown in overall economic conditions or a much more severe spike in inflation to see that kind of slowdown emerge in the index. Instead, it's just a rotation in the earnings stream, a moderation in the rate of growth and margin pressures that are a little bigger than most analysts had anticipated.
Just a reminder, folks, that things just don't grow like gangbusters forever. Guys, thank you so much. Great setup on this Thursday. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence, and our Michael McKee, International Economics and Policy Correspondent, studying up for that monthly jobs report tomorrow.
Yeah, happening tomorrow morning. Let's get a check now. In the meantime, the latest world and national news with Denise Pellegrini in our New York newsroom. Hey, Denise.
Hey, Tim. Well, authorities in Tulsa, Oklahoma, they are now saying that the suspect who killed 4 people inside that medical building yesterday was a patient to one of the victims. And Tulsa Police Chief Wendell Franklin says Dr. Phillips performed back surgery and the suspect had a motive of sorts.
He blamed Dr. Phillips for the ongoing pain following the surgery.
And police say the gunman bought the AR-style rifle just hours before opening fire at the medical office. The House Judiciary Committee is debating a comprehensive bill that supporters say would tighten gun laws, but Judiciary Committee ranking member Jim Jordan says Republicans, well, they have issues with the bill that's on the table.
No one wants another tragedy. No one wants this to happen again. That's why it's regretful that Democrats have rushed to a markup today in what seems more like political theater than a real attempt at improving public safety or finding solutions.
And President Biden is expected to address the issue Jordan just mentioned there. The president is scheduled to speak tonight about gun control. We'll be carrying his comments live for you and also be taking a close look at gun control coming up at 5 p.m. with Sound On with Joe Matthew. The sentence is in for celebrity lawyer Michael Avenatti in that fraud case from his most famous client, porn star Stormy Daniels. A federal judge in Manhattan has handed down a 4-year prison term for stealing hundreds of thousands of dollars in book advances from Daniels. Avenatti was convicted in February of wire fraud and identity theft. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini. This is Bloomberg.
All right, thank you so much for that update, Denise Pellegrini, joining us live from our New York newsroom. Let's get now to one of the most read on the Bloomberg terminal. Tim Stenbeck and Carol Massa were live in the Bloomberg Interactive Broker Studios in New York. This one an exclusive by our own Hema Parmar about Tiger Global's 52% plunge, prompting a fee cut and a redemption plan. If you've been listening to us in the last couple of weeks, you've heard Hema's voice a lot because she's been covering this space in a great way. She's been so busy. And this latest is another example of one of her exclusives.
Yeah, this story actually, we're going to feature it too in our weekend show, which comes out Saturday morning on Bloomberg Radio, also on our podcast feed, 8 a.m. on Bloomberg Radio Saturday morning. So losses at Tiger Global Management, check out this, reaching 52% this year, prompting the firm to cut management fees and create separate accounts for the illiquid wagers of customers who want to redeem.
This is crazy. So the firm's hedge fund sank another 14.2% last month. It was buffeted by losses in several stocks and substantial markdowns in its private assets. That's according to an investor letter seen by Bloomberg and a person with knowledge of the matter.
Right. As the value of its public holdings plummeted, Tiger's exposure to illiquid venture capital bets comprised too much of its portfolio, leading the firm to tell investors in its hedge and long-only funds that if they wish to redeem, their private investments will be placed in a separate account that will be cashed out at a later date. The firm also cutting management fees for the hedge fund by 0.5 percentage point to 1% through December of 2023. Its performance fees, though, 20%.
52% is how much the fund has sunk so far in 2022. So, Carol, as you mentioned, to compensate for putting their illiquid bets in so-called side pocket accounts, Tiger is allowing clients to pull more of their cash, regardless of any lockup terms. Customers can redeem as much as 33% of their investment this year, up from the usual limit of 25% from the hedge fund and 20% for the long-only product.
So this is where hedge funds, right, are supposed to outperform, but also protect you on the downside.
The hedge part.
Yeah, it's kind of missing, right? Like we said, Hema covering this, Tiger Global not alone, certainly in this. So check out more of that story. You can also head to Bloomberg.com for all the details. This is Bloomberg.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market has recovered from some early session weakness, and in fact, the major indices right now very near the best level of the day. Looks like we're on our way to snapping a two-day losing streak. The day began with a warning from Microsoft on the negative impact of a stronger dollar, and we've heard from some Fed officials as well. Fed Vice Chair Lael Brainerd saying it's hard to see the case for a pause in Fed tightening in September. And then on top of that, the head of the Cleveland Fed, Loretta Mester, was saying consumer spending is still holding up, and that's easing concern about slower growth. Now, the Fed's blackout period, so to speak, will begin on Saturday. So no more Fed speakers after that point, ahead of the next policy meeting on June 15th. Then we have the oil story. The cartel OPEC Plus agreeing to increase the size of supply in the month of July and August by about 50%. But the market is focused on a drop in U.S. crude inventories, and that's the reason that we're seeing prices push higher today. WTI right now up about 1.3%. We're trading 116.80. In terms of the equity trade, Dow Industrial Average is better by about 0.8%. The S&P up 1.4%. NASDAQ comp better by about 2.4%. Stable Treasury yields and much dollar weakness with the Bloomberg Dollar Spot Index down right now by about 0.7%. We'll take another look at market action for you in 15 minutes. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. We're watching the energy markets once again. OPEC Plus agreeing to increase the size of its oil supply hikes by about 50% in a deal that kept Russia at the heart of the cartel, while also heating pressure from major consumers, including the United States. Meantime, we've got the EU approving a 6th package of sanctions, including a partial ban on Russian oil imports after further objections from Hungary held up an agreement.
Great to have with us right now Dr. Ellen Wald, president of Transversal Consulting, also senior fellow at the Atlantic Council and a Bloomberg opinion contributor. Ellen's joining us on the phone from Jacksonville, Florida. Dr. Wald, good to have you with us. Can you explain to me why, given the news that we got from about OPEC increasing the size of its oil supply, why we're not seeing oil prices pull back at all?
Exactly. Well, part of the reason is because we're unlikely to see the amount of oil that actually get on the market that OPEC is talking about increasing their quotas by. So, we're talking about an increase of about 650,000 barrels a day for the group's quotas. But at this point, really only Saudi Arabia and the UAE can increase production. And so the maximum amount of production we can see it increase out of Saudi Arabia that we would expect to see would be about 170,000 barrels per day, which is really not that much when you consider the size of the global oil market. So while a lot, OPEC members
on for an upcoming Bloomberg event, and we were reminded that there are energy booms and energy busts. And he says this is cyclical and it will settle down again. And so, do producers think about that? And especially when you think about the major integrated global oil companies, that in terms of kind of investments to really ramp up supply, they're going to be hesitant because they know it's cyclical. And there's also a world that we're supposed to be increasingly moving towards alternative energy.
Well, I think that they are definitely aware of the cyclical nature of the oil market, and oil companies are used to this kind of boom and bust. In fact, if you look at hiring when it comes to oil companies, they'll hire a lot of people when things are good, and then when prices collapse, a lot of them end up getting laid off, and that's kind of the nature of the business. It's interesting because high oil prices do tend to spur investment and development of new resources, but that takes time. It's not something that happens overnight, and I think it's taking a bit more time in this cycle because there's so much external pressure on oil companies not to invest in new resources, be that from shareholders who are really just looking to see oil companies putting their profits back into dividends and other things to return money to shareholders, or we're also seeing pressure from governments that are making it very difficult for companies to develop new resources the U.S., for example, there's been a lot of regulatory uncertainty with the Biden administration, and that makes companies very hesitant to expand. We're just now starting to see companies in Europe expanding in new gas fields, for example. But those kinds of fields are not going to come into production for some time. So we may be into a period of it may be a bit of an extended period of high prices, just like we saw an extended period of low prices preceding it.
What does an extended period of high prices mean? Because everything that you just said, Dr. Wald, makes me think that there's no end in sight to $5, $6 gallons of gas at the pump and high energy bills in summer and winter.
And I'm curious what extended means and how high it might go in that extension.
Well, how high it goes depends on a lot of things, and also we are seeing part of what we're seeing in the market is also there's a premium in prices, both electricity prices and gasoline prices, from the geopolitical events in Europe, without a doubt. So if that were to say be resolved in the next couple of months, I think we would definitely see prices pull back. Although I really don't know if barring if we're still at the same levels of demand, I'm not sure that we would see a return to say like $40 or $50 or even $60 oil. We'd probably be more firmly in the $70, $80, maybe $90 area. Now that of course sounds great when you're talking about prices are like 111 today.
Right.
So so it is all kind of relative, and the oil market is very volatile right now, and it does depend. If we enter a period of economic recession and potentially contraction, we could also see demand drop, and that could help cause oil prices to pull back some. Though I still don't see us getting back to those low numbers that we had, in 2019 or 2017.
Ellen, just quickly, just got about 30, 40 seconds here. Will, though, today's current situation, geopolitical crisis, lead the world to think about Venezuela more aggressively, despite problems, obviously, with that political environment, or President Biden meeting with MBS in Saudi Arabia? I mean, do we need to think that these alliances are going to have to change? And sorry, just got about 20, 25 seconds.
Yeah, I think it's difficult to say that because Venezuela has such issues with its oil industry anyway that we can't expect a lot of oil to come on the market from them anyway, regardless of the political situation.
Ellen, always nice to get time with you. Dr. Ellen Wald, she is president of Transversal Consulting, senior fellow at the Atlantic Council, Bloomberg Opinion contributor, and she also wrote the book Saudi Inc. on the history of Aramco, in Saudi Arabia. You're listening to Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So what happens when you have a front row seat to the two largest and most successful advertising platforms in history?
We're talking about Google, also known as Alphabet, and Facebook, also known as Meta Platforms. And the person, Sheryl Sandberg.
Incredible. So we're going to talk about that advertising empire that Sandberg has created and how it kind of leaves a complicated legacy, especially for Meta Platforms.
Well, speaking of complicated, I don't think that's necessarily how we describe today's trade, but Doug Krisner is here with the details as we get to under 90 minutes until the close. Hey, Doug.
I guarantee to make it complicated. How's that?
Sounds good.
You know, one of the byproducts of rising interest rates has been a stronger dollar. We've known that that's going to be, at some point, a potential headwind for multinational companies that derive a great deal of their revenue from overseas. Well, today, we kind of fortified that view when we heard from Microsoft warning on the negative impact of a stronger dollar. Now, at the low point of the early going, Microsoft had been down by about 4%, but the stock has turned around right now, along with the entire equity market. Microsoft is trading up by 0.3% right now, and the major indices are near their best levels of the day. S&P 500 up about 1.4%. Some Fed speak as well today. Vice Chair Lael Brainerd saying it's hard to see the case for a pause in Fed tightening in September. And Loretta Mester, who is the head of the Cleveland Fed, said consumer spending is still holding up, and that's easing concern about slower growth. Not a lot of movement in the bond market today. What's interesting is that we're seeing a great deal of dollar weakness. Now, some of this coincides with a move into currencies like the euro and the yuan. Look at China, for example. The cities of Shanghai and Beijing are beginning to lift their virus restrictions. That's creating a little optimism about some economic activity maybe improving on the mainland. The offshore Chinese currency right now stronger against the dollar by 0.6%. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, thank you so much. So as you know, we were all over the breaking news of Sheryl Sandberg announcing her plans to resign as COO at Facebook after 14 years. Facebook, of course, now known as Meta Platforms. Our team has been working on this story to advance it, and among their findings is Sheryl Sandberg's advertising empire and how it leaves a complicated legacy.
Joining us now is Ellen Hewitt, startups reporter for Bloomberg News. Ellen joining us this afternoon on the phone from San Francisco. Ellen, everyone knows the news if they've been paying any attention over the last 23 hours, but I want to talk about the legacy that Sheryl Sandberg leaves behind. It's interesting because she came from Google, where she helped scale that company's advertising business, and entered Facebook in 2008 when it was 4 years before it went public, and it had no mobile advertising business until years later. What's the legacy that she leaves behind?
Yeah, I think she is such a fascinating character in the pantheon of Silicon Valley, most influential people. One of these people that is known almost by her first name only, right? Like if you say Sheryl, people know who you're talking about. And I think that's because she has been such an important part of these two companies, especially at Facebook, creating, I think one analyst said, her legacy is having created one of the strongest strongest business models in the digital economy. That's really an impressive feat. And even though most people at home might know her as doing more of the lean in stuff, I think actually her biggest impact has been, on the championing this ad model of personalized ads that created just endless revenue for Facebook, and before that for Google as well.
Well, and what's interesting too, I think about, the Facebook IPO initially, such a bummer, and then how quickly the company pivoted, in terms of, I think it was mobile and advertising, but help me out here. But I wonder how much of she was behind kind of the rethink of what the company needed to do.
Well, I think when she joined Facebook, keep in mind this was only, I believe, 4 years after Facebook really started. You're right, they weren't doing mobile advertising. There was a lot that we think of as part of Facebook's ad model now that didn't exist at the time she joined. This was, 14 years ago. And I think she has just been executing year after year on growing this business. I think there's this very telling quote that several people have shared about her, which is she would tell people that she worked with that she felt that she was put on earth to to scale organizations, like that this was her calling in life, her mission. And according to everyone who's worked with her, she was incredible at it, right? So this is a person who had not only the aptitude, but the single-minded vision to grow, and by all accounts was very good at it. Of course, I think when people look back on her influence on the Valley, they're also going to see a lot of the negative effects of massive scale that came with that growth, immense profits and also enormous problems.
Well, let's talk about some of those problems.
This
because,
is the complicated legacy part.
and like I said to Carol, I mean, that's life. Life is complicated. So where did the problems kind of begin when you look back at Sheryl Sandberg? Because Facebook went from being this company, and look, I think early on there were problems with the news feed and people got upset about privacy, but then things started to get serious when regulators got involved.
Yeah, and I think that has to do with just the reach of the company. And there are lots of people at Bloomberg who know a lot more about this than I do. But it does seem like if you talk to people who worked with Sheryl, they really point to 2016 as this period, this moment in time in which Facebook kind of stopped being this like, wow, so powerful, and started being like, oh no, this is really bad. And that's, I think, maybe the problems started earlier, but the public perception shifted around then. I think we're talking about, allegations of allowing Russian interference in the 2016 election, and then it just kind of goes from there. You have Cambridge Analytica. Yeah. You have these allegations that Facebook helped foment genocide in various countries around the world. Obviously, like other sort of problems with not regulating misinformation or hate speech. I think these were things that got bigger and more influential the bigger Facebook became. It's possible that they were still problems earlier on, but given the size of the company, maybe they weren't as big a deal. And then, given the enormous size of Facebook and its various platforms, the bigger it became, the more important its problems became as well.
Ellen, is in terms of the timing, it kind of all makes sense as Mark Zuckerberg transitions much more to the metaverse, and the conversation, the thinking is more about individuals owning their own data. So it really is kind of a big shift in the model. Does it all kind of tie together well in your view?
Yeah, and when you talk to people who work with Sheryl, they say, people kind of knew that she might leave eventually, and then there was a lot of whispers about it, and everyone thought like, well, maybe this will be the year. But it does seem like one of her motivating factors is, she's very energized and very passionate about her philanthropy. So not just women's empowerment and lean in, but also, various other causes that she has. And frankly, they said that as Facebook became more and more of this villain in the eyes of, regulators and the public, it became much harder for her to do any sort of philanthropy, because as soon as she would step into something, all of the questions that came around, her responsibilities at Facebook would come along with her. So it just became this, one person described it as an elephant in the room. Like she was really not able to do anything unrelated to Facebook, and she may have wanted to pursue that more in this part of her life.
Just in 30 seconds that we have with you, what do you think Sheryl Sandberg does after this?
I mean, I think she does want to give back. My guess is that she feels like she has this incredible power to execute. Yeah. Everyone who's talked to her, says she does. And the question is just, where will she apply it?
All right. Well, interesting and really spot on second day story. So really appreciate some time getting to talk with you. Bloomberg News startups reporter Ellen Hewitt on the phone in San Francisco. Right now, we're going to turn things over to David Weston, host of Balance of Power on Bloomberg Radio and Bloomberg TV. He's getting ready to sit down with BlackRock chairman, CEO, and co-founder Larry Fink, of course, the world's largest asset manager, really talking about the market environment today. Let's head over to David and Larry Fink.
Radio and YouTube audiences around the world. I'm David Weston, and we welcome now Larry Fink. He, of course, is the founder, the chairman, and the CEO of BlackRock. So welcome, Larry. It's great to have you.
David, it's great to be on set, and it's nice to be here on set.
Isn't it nice? It's like the real life again.
It feels like life is coming back.
Isn't that a nice thing? So, talking about life coming back, the markets have had sort of a rocky road, can we say, so far this year. As you look forward, is there any real prospect they can recoup in the second half of the year?
Probably not totally. Let's start off. The market has recalibrated itself. We witnessed now a change in policy in the Federal Reserve. We raised short rates. So we saw a recalibration of growth stocks That's principally the majority of the downfall, and yet the index are masking some of the problems because part of the index are energy companies, commodity companies that are up quite a bit. So if you look at the volatility in the market and the spread between winners and losers, it's pretty broad this year. And so we've taken out a lot of those gains that we saw during the COVID years and during the 2 years where we were, changing our lives and we were emphasizing different companies, and now we're seeing the reverse impact of that. So that was one of the foundations of it. But now there's greater recognition that inflation is not transitory. It is probably with us for a number of years. And it's the type of inflation that I don't believe the Federal Reserve has the policy or the tools to do much with it right now. And I'm personally not blaming the Federal Reserve for where we are right now. But I believe most of the problems we're living with today are more policy generated and supply generated. Demand right now in our economy is equivalent to the demand that we saw pre-COVID. And so we're witnessing all these supply shocks, and that's creating these attended price increases. And so it's more supply driven. It's been aggravated now, obviously, by COVID and lockdowns in different parts of the world where we are manufacturing goods. It has been further aggravated by the Ukraine-Russian war and where we have supply shocks. But I have this fundamental view that much of the inflation has been generated by some very large policy shifts in the United States.
And I want to talk about exactly what caused it, but just before that, we have Jamie Dimon talking about a hurricane, potentially. Are you saying something that significant? What's the chance of recession? Not so much this year, but in 2023 or even 2024?
Well, I think Jamie said one outcome could be a hurricane. It may not be that. So, I know that sounds so perfect for the media, a hurricane, but I could see scenarios where it could be quite bad, another downward draft of significance. And that's going to be dependent on earnings going forward. But I could also see a scenario where we're going to be muddling along for the next year or two, right around this level. And, maybe up 5%, down 10%, but we're going to be in this range-bound area until we have better information. I mean, the one thing I will say with total certainty, we're going to be living with more uncertainty. And so with that in mind, we are going to have bouts of fear, which is going to bring down the markets and a little more confidence going on forward. But we have not witnessed huge asset allocation changes by our investors.
Well, I was going to ask about that. What are you seeing in your funds, for example? Are people buying bonds again, for example, in your funds?
Oh my gosh! In the month of May, we had the biggest increase in ETF bond purchases. We had $30-something billion of inflows in bonds, whether it was credit or all that. So you were certainly seeing a revaluation of how far interest rates need to go upward, and so that's also one of the big trends. I mean, I'd say 30 days ago, many people were calling for a deep recession, and now people are mitigating that. Obviously, there are views that we could have a deep recession or a hurricane, but that's just one of the outcomes. I mean, I think there's higher probabilities of outcomes that we're going to be more range bound with a lot of volatility.
Certainly, there's uncertainty about exactly what happens with the Fed. Maybe not so much on rate increases as what the consequences will be of the quantitative tightening, which actually started this week. What are those consequences likely to be in your judgment?
You better find new buyers. I think the marketplace does not understand the dependency of low rates was on the QE purchases, the trillions of dollars at the Federal Reserve. But let's all be clear, between Japan and China, they own close to $2.5 trillion of U.S. treasuries too. So there are big owners and big players, and obviously what will be the future clearing price at rates with less QE and now a reversal of it? Do we need to get up to a 3% 10-year to meet a lot more demand? And so much of this is we're all going to have to see what are the consequences. If the demand that we saw in intermediate treasuries in May carry on, QE may not be, the reversal of QE is not going to be as big of a problem. If we have that fear that inflation is going to be longer and higher, then obviously we're going to have to reset all that, and we're going to probably have higher rates. But I'm of belief that we don't have to have much higher intermediate and long rates.
For our global television, radio, and YouTube audiences, this is a simulcast with, of course, Larry Fink. He's the chairman and CEO of BlackRock. Let's go back to something you raised, Larry, and that is inflation. Not just what it is, but what has caused it. Because we've been told in the past, for example, from Chair Powell, that he's got the tools he needs to take care of it. Right now, the data don't necessarily indicate that he's taking care of it yet. Do we have the tools?
Well, first of all, I'm a strong believer in Chair Powell and the Federal Reserve doing the right thing. I have great confidence in his abilities to assess the market. So he may know a lot more than I do, so I'm not going to be judging him. I believe the problems of inflation are not Fed-related as much as policy-related. So I believe inflation is really based on some big macro policy changes that are now that had good intentions, but the unintended consequences are more inflationary. For instance, post-World War II, America's foundation of economic policy was based on consumerism. We built this entire economy post-World War II with a belief that if more Americans can have more things, then we have happy Americans. And we built a whole geopolitical platform around that. And then with the fall of the Soviet Union and we had the peace dividend, we were able to accelerate globalization and building things. And that's one of the fundamental reasons why we had deflationary pressures for the last 30 years, that whole movement towards supply chain navigation and lower prices. I would say 10 years ago, the rise, whether you call it nationalism or the rise of this belief that we have to focus on communities that have been devastated by globalization. We need to find ways of creating better jobs for more Americans. That in itself is inflationary when you move away from the cheapest price ever to another area. And so that's a fundamental change. We changed our immigration policies, and I'm talking about legal immigration, okay? Our legal immigrations, that was changed about 5 years ago, where we've reduced the amount of legal immigration. If you look at the rate of increase of immigrants, legal immigrants in the United States from 2000 to 2017, and the rate that we are growing immigration in the last 5 years, we're down 2 million. 2 million new entrants to the United States legally. That is very inflationary when we have full employment, when we have these jobs. Think about all the need for workers. What does that mean when we start implementing our infrastructure bill, when it's going to take up quite a few new jobs? Where are those employees going to be coming from? It's going to create rising wages. And if you look at earnings, many companies are saying rising wages are a part of their degradation of their margins.
And maybe to add to that, we're also going through an energy transformation globally. Totally. And that can't be free.
And I've said in my letters that energy transition can be highly inflationary. And I've always said that an energy transition must be fair and just. And we can't be just mitigating supply. We need to be finding solutions. So we have a strong view on that if we don't find a way to be working with the hydrocarbon companies, with the energy companies, making sure that we have adequate global supply of hydrocarbons at the same time, move technology to create a more decarbonization platform and pathway, and it's not going to be a straight line. It's going to be lumpy like what we're seeing now. So that is also inflationary. And let's be clear, the $7 trillion, I want to underscore, $7 trillion of fiscal stimulus during the COVID years is beyond any stimulus we've ever seen in fiscal policy in our history of a country. So you add all those things up, it was a foundation of inflation. And then you overlay the Russian-Ukraine war and the supply shocks, and then you overlay now COVID and the lockdowns and what it's doing for supply chains. All of that is adding on. So getting back to the Federal Reserve and your question, the Federal Reserve does not have tools to fix supply problems. The Federal Reserve's tools, like every other central bank, is to reduce demand through higher interest rates. As I said, I don't think we have a demand problem. We have a supply problem. And so if they believe they have to change demand, that will put us into a recession. And I believe we need more time. So I'm under the belief we're going to have a 2-year period of time of elevated inflation. But I do believe as we reconstruct our supply chains, we find better sources of energy in the interim, as we create more decarbonization technology, all of this in 3 or 4 years is going to work itself out. And when you talk to the energy complex of today, they believe fair value for gas, for oil is about $70 to $80 a barrel. Right. And so we've seen this before. We're in this transition, and I do believe within a few years we'll be back to $70 to $80 oil.
Given all of that, is it realistic to have a 2% target on inflation? Or are we actually encouraging the Fed, in a sense, to do something that will drive us into recession? Because given there are fundamental factors that push that number above 2%, should we be really rethinking? And what does that mean for investors if we're looking at a 4% inflation world?
Well, I think we are living in a 4% or higher inflation world for the next 2 years. Investors are going to have to look beyond this period. The question is, what will happen in 3 or 4 years? Is this going to be a short-term pop? I mean, you even heard one of the governors yesterday talk about, we need to raise rates a few more times, and then I can see in a year we're going to lower rates. Okay, and so in my opinion, we need to get to a 2% level, just to level set and let the data determine where it is. But I do believe, because this is supply generated and policy generated, not as much monetary policy generated, it's hard for them. If they overshoot, we'll definitely get into a recession, and then they're going to have to ease very quickly, and we still may have the supply problems. And in all the conversations I have with business leaders around the world, and I've had a couple meetings in the last 2 days with some significant CEOs of major international companies, and they're all talking about the supply problems, and they're also talking about the need of labor, and they're all seeing this problem, and it's a real big issue.
One other thing that you've been outspoken on, and that's environmental, social, and governance, ESG investing, and it became quite the vogue. At the same time, now it's getting a little bit of tarnish on it. For example, on some of the greenwashing allegations that we saw, certainly with the DWS, but also the SEC going at it. What do you make of greenwashing, and what should be done about that as a problem?
Well, I could tell you what we've done. We've always believed this could be data dependent, and so we've been very aggressive in building out analytics and data so we could look at and review and judge companies through the lens of better understanding of how companies move forward in a decarbonizing world. We overlay satellite imaging and technology to understand how physical climate risk can impact an asset, a piece of real estate, an office building, a factory. And so we believe we cannot move forward without a proper taxonomy. And I do believe the SEC has to be focused on that. But importantly, let's be clear, clients in Europe are actually more aggressive on moving towards sustainability, not less. Europe right now today, they have the existential problem of Russian dependency of gas and oil, and they're moving away from that. Europe actually said we're going from 2050 to be net zero to 2035. And so in actuality of gas and oil, and they're moving away from that. Europe actually said we're going from 2050 to be net zero to 2035. And so in actuality, they're accelerated their decarbonization process. At the same time, Europe did change their taxonomy. A year ago, their taxonomy said gas was brown. Magically now, because of the problem, gas is green. And David, I've always said, the energy transition is not brown to green. It's going to be from dark brown, the medium brown, the medium light brown, the light brown, and on and on and on. We may develop new technology to leapfrog a couple of those shades, but I can't see that technology yet. But let's be clear, to do this transition, and the problem is some environmentalists saying, Larry, we don't have time to do that. Right. And there lies the debate. Do we have time to go from dark brown, the medium brown, the light brown? We can all debate that. The question is, do politicians have the time to allow that? And there lies the construct that we're living in today.
And what's the best way into this problem? Is it through government regulation, standardization of these standards, or is it through things like shareholder initiatives? I mean, you said you're not going to back as many, I think, at BlackRock as you have in the past. We're going into the proxy season now. Do you anticipate backing any of those ESG
So
initiatives?
we're almost done with proxy season. In fact, in the U.S., we're done. We still have a few more in Japan. What we said, we're not going to be as prescriptive as last year. We're almost at the same level we were last year. I think the biggest change in proxy season this year, more and more companies are volunteering information. So there were much less issues in proxies this year. We worked really well with companies around the world. There was only a few companies where there was a large disagreement. And so I think people are, once again, are conflating the facts. The facts are, We said, and I've always been loud on this, we are not going to support Scope 3 at this time. Right. And the reason why I don't want to be the environmental police, I think it's wrong to ask the private sector to tell all the entire society we have to move forward. And I have no problem in doing Scope 1 and 2, but we've always said Scope 3 is forcing big companies, banks, and asset managers to be the environmental police. And I've been loud about this. I've spoken about this at COP26. I'm against this. A lot of people got angry at me. But I believe there are some strong merits. But let me be clear. The energy companies and all the attending companies, they're moving. And they're moving with a deep understanding. And there's not an energy CEO who does not believe we have climate risk. And they all, they may disagree in the speed in which we could fix this. But I was with a bunch of energy companies recently, and they're all trying to focus on how do we create carbon sequestering? How do we create carbon capture? This is going to be a big thing. And every energy company is focusing, how can we make hydrogen cheap enough to be a major source of energy?
One last one, Larry. You spend a fair amount of time talking to our leadership in Washington, as well as other capitals around the world. Right now, I think it's fair to say the Biden administration has got a challenge on its hand when it comes to the economy. It's not getting a lot of credit, whether it should or not. If you were to give them one piece of advice about what to do right now that could make some difference in the short to medium term, what would it be?
Fix immigration, for legal immigration. And I think we all would have said that. If you talk to all the business roundtable, the U.S. Chamber, I mean, we have to be really focused on things like that. We can build America back. But if we're going to build America back in a non-inflationary way, if we're going to grow America, we're going to have to do that not just with our own. We're going to have to allow legal immigration. We could bring, we educate over, a few million young people every year in advanced degrees in America, and it's harder and harder for them to get a green card in America today. We need to rethink about, the foundation of America. The foundation of America was on immigration.
Not catch and release, catch and keep, right?
We're educating and letting them go. That doesn't sound like a good policy to me.
Larry, it's been really great talking to you. Thank you so much. That's Larry Fink. He is, of course, the chairman and the CEO of BlackRock for our Bloomberg radio, TV, and YouTube audiences globally.
What a fabulous interview. We thank Bloomberg's David Weston and BlackRock Chairman and CEO Larry Fink. Of course, meanwhile, we are counting you down to the close. Just, a little over 60 minutes now in the trading session. And Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Masser and Tim Stenovic. And together we welcome our full audiences, still TV, radio, YouTube, all in on us together as we see a market that powers higher, but some very senior executives from Goldman Sachs, Larry Fink there once again echoing some concerns about recession risk, Carol.
Yeah, really interesting, a really thoughtful conversation by our David Weston and talking about more uncertainty. I feel like it does mirror so many of the conversations that we are having with executives. At the same time, we talk about unprecedented stimulus pumped into the economy during COVID, while China seems to be picking up that baton, increasingly pumping more money into that economy. And that's why, if we bring up the chart in terms of Chinese stocks that once again trade in the United States, we continue to see outperformance as China commits to growth stimulus for that economy. Those Chinese names up more than 4%, Tim, in today's trade.
Yeah, today's trade is a really interesting one. Stocks higher early on the news that OPEC Plus is going to increase output, then moving lower after we got that news from Microsoft that it's trimming its quarterly forecast as a result of a strong dollar. But since then, stocks have just moved higher and higher throughout the day ahead of this jobs report.
Volumes are pretty pathetic, though.
Yeah.
They're off by about 18%, if that's a technical term, pathetic. But people are still out. They're still celebrating some sort of warmer weather after, of course, the Memorial Day long weekend. Let's have a quick look at what's happening across the major benchmarks right now, because we're up about 50 points on the S&P 500, currently up 1.2%. But we are continuing to see the outperformance of big tech, more than 2 percentage points higher on the NASDAQ. We're seeing 0.7% higher on the Dow Jones Industrial Average. So the cyclical's not faring quite so well, but the Russell 2000 up 1.9%. Small caps getting quite the lift today, Taylor.
You see sort of a broader-based buying, of course, today, Caroline, than we did yesterday. I want to start with some of the big winners, of course, on the day. Discretionary technology materials, those are up anywhere from 1.7 to 2.5%. So that certainly feels pretty risk-on. Romain, I bring you down to the bottom of the screen. Energy, the only sector here really significantly in the red. You're off about 1.3%. A little bit of a reprieve reprieve on the back of an increase of a production here from the OPEC Plus team.
Yeah, we sort of talk about sort of what's moving this market. Microsoft, of course, had been the big drag a little bit earlier in the day, both in terms of its point contribution as well as in terms of sentiment. Microsoft shares were down as much as 4%. They're basically unched on the day, poking back into the green right around 272 as a lot of people kind of reassess here and say, okay, at the end of the day, they did kind of maintain at least that broader outlook here. And if they're confident enough to give a specific forecast, maybe that's a bright spot. At least that's kind of the commentary that we're getting out of some of our friends down at Bloomberg Intelligence. Meta Platforms, which had an awful day yesterday on the back of that announcement that Sheryl Sandberg was leaving. Investors also shrugging that off today. The shares higher by about 6%, recouping all of the losses from yesterday. But still a lot of concerns right now about supply chain issues. Hormel Foods down 6% right now. They came out with earnings, and there was a lot of talk about their turkey division, which actually makes up a big chunk of their sales, about 15% of their sales annually here. And they said, look, it didn't affect the first quarter, the most recent quarter, too much. But in the back half of the year, they're expecting a decline in turkey sales in that division of maybe as much as 30%. This is largely because of bird flu, something we haven't talked a lot about. But there's been a huge cull of birds out there, including turkeys, chickens, and the like here. And for a company that specializes in a lot of that poultry, this is going to be a big issue, particularly as you head into the latter half of the year where a lot of people do turn to those turkeys. And we still have some earnings a little bit later here, Carol. With Lululemon, could be coming out after the bell. The share's higher by about 3.5% right now. Look for about 22% comp growth. That's based on the average estimate of analysts surveyed by Bloomberg.
And all eyes on inventory, as we heard from Macy's, that people just aren't buying their leggings, their tights quite in the way that they were previously. Let's have a quick look at what's happening also in the OPEC news. You cited it, Tim, and really, this is a great chart coming from Dan Curtis and team and Kriti, really talking about how OPEC capacity versus previous production levels, like we're still so far away from the pre-COVID levels of production. Yes, we see OPEC decide to ramp up, fill the gap of where Russia had pulled back, but for this chart, for the radio audience, just shows that 650,000, let's call it, added barrels per day, still way off where we were in terms of supply from previous.
You know, it's pretty remarkable, right, guys, how many individuals we have coming out. I think about Jamie Dimon early in the week talking about a possible hurricane. Larry Fink reminded us that was just one scenario. To hear Larry Fink make his comments about more uncertainty. And then we also heard from the big conference in New York. What is it called? Yeah, the Annual Strategic Decisions Conference. Goldman Sachs president
rolls off the
tongue. John Waldron also speaking that. And just, you know, he has seen a lot of cycles, but he, again, kind of talking about today's really difficult times. Check it out.
This is among, if not the most complex, dynamic environment I've ever seen in my career. We've obviously been through lots of cycles, but the confluence of the number of shocks to the system, to me, is unprecedented.
And that is John Waldron of Goldman Sachs. Again, a reminder, and we have all talked about this, that again, we're coming out of a cycle that we really don't truly understand. And I think even Larry Fink talking to that, it's going to take a while for us to really understand what the true economy and what the true picture is. But at the same time, everybody keeps reminding us there is still growth.
Still growth. And we should point out, too, I mean, every time we sort of hear is kind of these dire forecasts, whether it's from Diamond or Waldron, they also sort of follow that up with the idea that everything's going to be fine, at least for them. I mean, they're going to make money, or at least their companies, I should say, are going to make money hand over fist. But they do have to sort of adjust to maybe what could be a new reality. But things are going to be tougher for a lot of Americans, and not just Americans, but really a lot of folks around the globe.
And you've seen some of those earning revisions come down. I think we have a great chart, which I'll
Are they
put
starting
out on.
to come down?
Sorry?
Yeah, go ahead, Dan.
Have they come down? Sorry, it's when I'm not next to you.
I always know I have to speak into your good ear, but you're actually not here, right?
I'm hearing. Earnings revisions come down a little bit. And I think what is interesting, I know that we were talking about Microsoft earlier, is I think perhaps maybe a sigh of release, Caroline, is that it was nothing fundamental, that in many ways it's just a currency headwind, and it isn't a slowing slowing sort of tech slowdown here on the horizon, if that's a piece of good news.
I know, but we are potentially, Anurag Rana saying, look, prepare yourself for other software companies, for other big exporters to feel the strength of the dollar headwind. And we heard from Ben Amos a little bit earlier that dollar strength is not done yet. The continued ramp up in Federal Reserve ahead of, yes, we've seen a bit of catch up. The Bank of Canada, for example, today talking more hawkish. We, of course, see the ECB wanting to move, and maybe with a 50 basis point move towards the end of the year, Tim. But overall, this is a US that is trying to move faster, and that does mean that certain US assets are more attractive.
Well, Larry Fink would say the way to bring down inflation is to increase legal immigration. When you have 1.9 jobs available for every one person, then that is what he says is the answer, especially in an environment where companies are raising wages in order to attract and retain talent. And then that's eating into margins.
You also have an aging population, right? So you've got to bring down and bring in some younger
What is it? Easier said than done, Romaine?
Yeah, has he looked at the political environment in this country? Yeah.
It's working well.
I mean, I'm not saying he's wrong. I'm just saying, well, there's being right and there's actual practicality.
But it's an important issue. Yeah. And all right, we've got lots more to talk about.
Still waiting for my green card, peeps. Still waiting.
No, don't let Caroline in. No. She's going to steal my job. See, this is what everyone's talking about.
Oh my God. All right, we're going to be back in less than an hour's time. We're going to count you down to the close on radio, TV, and YouTube. We call it Beyond the Bell on this Friday's Eve.
This is Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I think that immigration issue is an important one. And I think Larry Fink is talking big problems. He's like, the Fed's not going to fix your supply shocks. They don't have the tools to fix the COVID lockdowns, the supply chain problems. They can impact demand. And as Mike McKee reminded us, we've already seen that in auto sales and housing, which are most sensitive to interest rate moves. But the other stuff, sorry.
Right.
Got the tools.
Okay, so part of the Fed's mandate is, of course, stable prices. They have a 2% target on inflation, Carol, as you mentioned.
And that may have to run a little hotter.
And may have to run a little hotter. They've got, as Fed Chair Jay Powell has described to us, they've got blunt instruments in order to get us there. But what can the U.S. government do in order to help bring down inflation? And I think Larry Fink makes a really good point that if you increase legal immigration in this country and you increase the workforce, you get those people who come to the United States to be educated, you allow them to stay here and get jobs here easily, then that helps take pressure off the labor force.
Because what's interesting, if you go back to what Gina Martin Adams said, she goes, we're not in an earnings recession. Taylor Riggs over on our TV side, talking about what they're seeing in terms of earnings growth. Gina did say the pace of growth is slowing. Earnings are still growing, but the pace of growth is slowing, an important distinction. So she says, we're having a moderation of expectations, no earnings recession. But if the Fed does a misstep and is too aggressive in policy, you could certainly start to see that impact the labor market, right? And you start to see that slow, and that would be problematic.
A little bit of cooling off with the ADP number that we saw today.
Right. And we'll see if this is the start of a new trend line.
323,000 is
still
what
strong.
Economists surveyed by Bloomberg are expecting. As Mike McKee said on our program earlier, that even by pre-pandemic standards, that's a high number.
Right. But is it the beginning of, we've always talked about peak oil in the past. We've talked a lot about peak inflation. Like, you just want to see, I think, about charts, right? That rollover where you start to develop a new trend line. And I don't know. I think all of this takes some time, but things are cyclical. I was thinking, again, I keep talking about this panel I did and talking with the CFO of Chevron, like reminding us that, we do see energy booms, we see energy busts. And he, too, was talking about the price of oil, coming down to different levels.
It's not going to be up here forever. Listen to what, again, Larry Fink, in the next couple of years, he said $70 to $80 a barrel.
I thought what was interesting, too, is when he talked about in terms of what investors are doing, and there aren't major allocation changes. I think he said specifically that we have not seen huge asset allocation changes by our investors. So people kind of staying put. There is a point where you're losing and you just, what?
He did speak to inflows that he's seen in bonds.
Right.
In bond funds.
So new money. And we'll see if we get any more guidance in terms of how the Fed is seeing this scenario.
June 15th is when we hear from the Fed at the next, after this blackout.
All right, right now let's get to world and national news. Over to Denise Pellegrini we go. Hey, Denise.
Hey, Carol, you were talking about oil prices. Well, the White House commenting on it, praising OPEC Plus for speeding up increases in oil production. Spokesperson Karine Jean-Pierre also says the U.S. will continue to use all tools to address energy price pressures. Buckingham Palace says Queen Elizabeth will miss the Platinum Jubilee church service. That's apparently after feeling discomfort when she attended events related to the whole ceremony earlier today. Authorities in Tulsa say the suspect who killed 4 people at that medical building yesterday was a patient to one of the victims. Tulsa Police Chief Wendell Franklin says Dr. Phillips performed back surgery on the suspect.
We have also found a letter on the suspect which made it clear that he came in with the intent to kill Dr. Phillips and anyone who got in his way. He blamed Dr. Phillips for the ongoing pain following the surgery.
And authorities say the suspect bought his weapon just hours before the attack. President Biden tonight expected to urge members of Congress to work together to pass stricter gun control measures. And we'll be carrying the president's comments live coming up on Bloomberg Daybreak Asia. Another report that Russian leader Vladimir Putin is being treated for cancer. Newsweek says his cancer is terminal and is attributing the info to high-ranking intelligence officials. The U.S. slapping a new round of sanctions on yachts and other assets related to Putin, and the newly appointed U.S. ambassador to Ukraine has arrived in Kyiv. Bridget Brink isn't saying, though, if U.S. troops will also return.
Obviously, the president's and the secretaries and my focus is on achieving our goals, but doing it also in a way where we safeguard our people.
Global News, 24 hours a day. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. Carol Messer, along with Tim Stenovic here in our Interactive Brokers studio. We are streaming on YouTube. A story we wanted to bring to your attention from the New York Governor, Kathy Hochul, announcing plans to build 22 renewable energy projects, much of them solar power facilities, as the state aspires to achieve a zero-emission grid by 2040, so 18 years from now. I know.
Okay, you had the same reaction. I saw this. I saw this headline.
Like, do we
I clicked
have
on it
18
so eagerly.
years?
No, and also given where energy prices are now, we need this yesterday. And given the fact that, the nuclear plant just outside of New York City has been decommissioned as well. All right, so here's some details. The project should generate enough power to serve 620,000 New York homes for at least 20 years, spur $2.7 billion in private investments, and create more than 3,000 jobs in the state. That's according to a statement from Governor Kathy Hochul. Oftentimes, this stuff does change.
Is that enough home? Like, what percentage of homes is that in New York?
Well, here's an interesting statistic about cars. The 22 new plants are expected to generate 4.5 million megawatt hours of renewable energy annually, would help reduce carbon emissions by more than 2.2 million metric tons daily. That would be equivalent to taking over 492,000 cars off the road every year.
That's a lot.
Yeah, that's a lot of cars.
Yeah, I guess their goal is of obtaining 70% of their electricity from renewable resources.
This is so far away.
But I guess the one thing to think about is I wonder when it starts, because, right, they'll build plants and then it will be a gradual build. Yeah. I'm assuming so that maybe in a few years we start to see it, you know what I mean? Like it comes online. And so I wonder if in like 3 years, 4 years, does a plant come on or two plants come on and we start to have an impact?
Well, part of the goal, as outlined in this piece, is New York obtaining 70% of its electricity from renewable sources by 2030, so under 8 years from now. And then 10 years after that, zero emissions.
Okay.
So
do we have that? Do we have 8 years?
It's
getting hot out there. I don't know if you notice when you're in the sun. It's pretty hot.
I don't know if we have 8 years of paying sky-high energy bills.
Yeah, well, there's that issue, too.
That's the issue.
Or never going outside because it's so hot and we're getting sunburned and we're living in the metaverse playing, I don't know, Donkey Kong. Or something.
Well, I don't know what you're doing.
They're all looking at me in the newsroom. What is Donkey Kong?
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market very near the best level of the day as we make our way to the closing bell. That in about, under 43 minutes from now. Let's get you updated on the latest in price action. Bailey Lipschultz is at the Bloomberg Macro Squawk Desk. Hey, Bailey.
Yeah, good afternoon. Stocks have powered higher and are trading near session highs after a mixed bag of economic data. The Dow is up 300 points, S&P higher by 60, while the Nasdaq gains 285 points. The U.S. 10-year yield is at 2.92%, and small caps are higher by 20 points. 10 of the 11 main S&P sectors are trading higher, led by gains in consumer discretionary and communications, with energy as the lone group in the red. Nasdaq Biotech's dipped 5. Transports are higher by 240 points. Semis are up 3%, while the VIX is lower by 2.8%. Leaders in the Dow, Salesforce, Boeing, and Nike, while Amgen, Merck, and J&J are the worst performers. After earnings, Chewy soared more than 20% as net sales topped estimates. E-commerce peers like Etsy and Wayfair are up big today, while HPE is on pace for its worst day since November after weak guidance. Moderna dipped after a delay in its vaccine deliveries to the EU, while Harley-Davidson outperformed as production is set to restart next week. Wrapping things up, look for earnings from CrowdStrike, Lululemon, and RH after the bell. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz.
All right, Bailey, thank you. And to get live audio updates on the Bloomberg Terminal, it is SQUA, then the green go key. I'm Doug Krisner. That's your Bloomberg Business Flash.
You know, we heard, Doug, first of all, thank you. We did hear David Weston talk about this in his conversation with BlackRock's Larry Fink about Deutsche Bank's embattled DWS Group, the CEO resigning hours after a police raid at the asset manager, the culmination of months of controversy surrounding the executive. But it really was about allegations by the company's former chief sustainability officer. The company inflated its ESG credentials. You and I talk a lot coming off of Milken, so much ESG conversation that it does feel like that space is going through a reckoning.
Yeah, and interestingly enough, Larry Fink said that BlackRock doesn't want to be the, quote, environmental police. We've got a great voice on this. Garvin J. Bush is the co-founder and chief investment officer at Green Alpha Advisors. It's based in Boulder, Colorado, but we got Jay with us right now. Garvin, we've got you with us right now. How are you? It's good to have you.
Jay? That would be actually kind of cool.
I was looking
sometimes.
GJ?
Yeah, I was looking right up at the J Bush. It's good to have you with us, and it's good to have you with us in the Bloomberg Interactive Brokers studios. It's been years since you've been back in the studios.
About 3 years. Carol just looked it up.
I did.
And it's great to be back. Thanks for having me in, you guys.
Well, how has the conversation around ESG shifted? Because I think Carol makes a really good point. We're sort of seeing this backlash right now.
It's interesting. I think cynically, I might say it's interesting to me that ESG has finally achieved enough success that it's getting pushed back from the more incumbent part of the industry. A little less cynically, I might say that while, of course, everyone has their First Amendment right to criticize whatever they want, equally, we all can invest by whatever criteria we want, right? That's how markets are. That's how they work. So that could be, I don't know, value or growth or momentum, or it could be thematic, right, including ESG. And over time, the markets reward the best ideas and the things that grow the most and compound the most and have the most intrinsic value. So this isn't going to be won or lost by rhetoric, but in the end, the markets will bear.
Whoa, wait a minute. So I'm just thinking, if I'm going to commit money to ESG, like I expect it to, like you guys are all about companies whose products and services address the global economy's greatest system level risks.
Yeah.
You know, I want my money potentially in an area that is not going to impact negatively the environment or something, you know. So I do wonder, to some extent, if you're selling something that it's going to do something, doesn't it have to do that?
I would argue very much that it does. And in fact, at Green Alpha, we don't brand as ESG for that reason.
You don't? I was going through your website, I'm like, I don't see that anywhere.
Yeah, thanks for noticing that.
Yeah.
No, we want to go right after the actual solutions to our most key system level risks that actually have the ability and are threatening to undermine the global economy and therefore undermine the reason we invest, right? Growth of assets.
So what are the biggest risks, Garvin?
So we define those as the climate crisis, resource degradation, farmland, topsoil, water, those kind of things,
right.
Human disease burden, and that could be pandemics, cancers, diabetes, what have you. So anything that lowers the overall total risk to the global economy is something we're interested in. If you're raising the risk to us all, we're going to pass. So that's not quite ESG.
But is the alpha there, and has the alpha been there? Because look at what we're seeing with markets this year. Best performer in the S&P 500, energy. 2021, best performer in the S&P 500, energy. If you're not invested in energy right now, you're feeling a lot of pain.
Yeah, and how about defense? Also doing quite well.
Yeah.
Right. Well, so that is a good point, and I can point to the mutual fund that I manage, NEXTX, not to plug it, but it's about 9.5 years old. It's got a comfortable 400-something annual average basis point lead over SPX. That said, it's much more volatile than SPX, right? It's up more on bull markets. It's down a little bit more in bear markets. Overall, that's a pretty handy track record of outperformance, and yet it's uncorrelated. So our thesis overall says that volatility and structural risk are not the same thing, and we'd much rather invest to mitigate structural risk than short-term volatility. So we think of ourselves as a long-term strategy. Like for us, 5 years is short-term.
So when you drill down a little bit, because I'm always interested in the specific companies and kind of ideas that you're thinking about. So tell us where you go.
Right. So mitigating those system-level risks we discussed. I guess I'll just start with health, human disease burden. We really love. Sure.
No, go. Because I was going to say, would a Moderna, would a Pfizer?
Yeah, we do have Moderna. We've had it since before the pandemic. We caught it very early, which was nice, of course.
Sweet.
But it was because thesis. It was what owns a bunch of IP around something that is transformative, step change way of doing things. So not a big pharma that's going to tweak small molecules a little bit, but what's cracking, evolution.
So messenger RNA.
Messenger RNA.
Before anyone knew what mRNA was.
Right.
Yeah, so BioNTech and Moderna, both on that basis, were in our strategies. But then elsewhere, things that are that are addressing cancer in a way that could be a one-and-done treatment. So CRISPR Therapeutics, Editas Medicine, Arcturus, Beam Therapeutics. The guys that own the real IP around how to use gene editing to just fix human disease.
So what do you think of someone like, and we just got about 40 seconds, a Kathy Wood who does think in a different way, and I feel like she's become a target. I've talked to her a lot. We've talked to her a lot.
Yeah.
I mean, in terms of her think, it doesn't sound like it's that dissimilar to some extent. And just got about 30 seconds.
Sure. Kathy's strategies and ours, I've co-presented on a panel with her once or twice. We've compared notes a little bit. I wouldn't say I know her. We're similar in that we both value innovation. We both very much value important intellectual property estates. Where we differ is ARC, and I hope I'm not out of turn, but it seems to value innovation for its own sake. Green Alpha values innovation in the service of solving a system-level risk. Okay. So there's a key difference as well.
Really fascinating. Now that we've reconnected, come back soon so we can continue this conversation.
Thank you.
All right, be well. Garvin J. Bush, he's co-founder, chief investment officer at Green Alpha Advisors, based in Boulder, made his way to New York City on this Thursday. This is Bloomberg.